Can you really retire on $200,000 per annum if you start investing in property in your 30s? The answer is yes, and let me show you how we're going to make that happen. So in this scenario, we've got a young couple with no kids who are in their early 30s. They're on a combined income of around $300,000 a year. One of them is on $157,000 and the other is on $174,000. So a combined income of about $330,000. Now, this is the key to building any real wealth long term. And I don't care about what horseshit people try to sell you. You cannot grow a multi-million dollar portfolio if you have minimal income. So from my point of view, before people should focus on investing and starting to grow their wealth outside of their own income, if they aren't earning a strong income, they should focus on being able to increase that as much as they possibly can. Now in this scenario, this couple has purchased their first property in 2023. They're purchasing their second property in 2024, which is this year. And they're purchasing their third property in 2026. All three properties are under $1 million in purchase price. And we only use the equity from each property to purchase the next property. So we're not injecting any of our own cash for deposits or costs, other than obviously the first property. And then you can see in 2038 and 2039, we make much larger purchases, and I'll get to those, but we don't do anything between 2026 and 2038. Now, the first thing we need to look at is the passive income target. We want to be hitting $200,000 per annum, but inflation adjusted out at 2.5% per annum over the next 20 odd years. We don't need to be targeting $200,000. The number we really need to be targeting is $320,000 because at 2.5% per annum inflation over the next 20 years, that's what it's going to do to our dollar. So you can see in 2024, by the time we make this next purchase, we'll be negative $55,000 a year pre-tax cash flow. Now, by the time we factor in our negative gearing and depreciation, we'll be able to claim about 30% of that back. So we'll be sitting at about a $35,000 to $40,000 a year negative. And that's with two properties. Now, by the time we purchase our third property in 2026, we'll be sitting at an $88,000 a year negative cash flow. Again, that's pre-tax. By the time we factor in our negative gearing and depreciation, that'll bring that down to around about $50,000 a year. All right, so once we purchase this second investment property, our market value is going to be sitting at just over $2 million. We're going to have equity of $416,000, which means we're sitting at about an 80% loan to value ratio. Total debt of just over $1.65 million. And we're sitting on about $175,000 worth of cash, which is about a 10% of total debt buffer. Now, what I mean by that is our total debt level is 1.65 and we're sitting on $175,000 worth of cash, which essentially means in comparison to the debt that we're holding, we're sitting on about 10% worth of cash, which is a strong buffer amount. But obviously as our debt increases, our buffers also need to increase. And that's essentially just to minimize our risk. All right, we then get to 2026. The portfolio has obviously grown and we purchased that third property and our total market value is worth just over $3.2 million. Our debt again is sitting at $650,000. We're sitting again at about an 80% loan to value ratio, which essentially means as soon as we have enough equity to buy property number 3, we release that equity and we purchase it. Our total debt sitting at $2.5 million. And our savings is then sitting at $140,000, which means we are sitting lean in the buffer department. But I'm not super worried about having less buffer at this point in time because this is the last property we're buying for a long period of time, which means we're going to have enough time to be able to continue to save and build up our buffers. Now, the reason we don't need to buy any more property is because we are investing for an outcome, not just investing to invest. So from 2026 to 2035, we literally buy no properties. And the reason for that is because we call that the incubation period, which is essentially when we've built up the portfolio, we've got a strong gross asset base, and then we just want to allow the marketplace to do the heavy lifting and grow our wealth. So during this time, all we're doing is allowing the properties to grow, putting all the cash that we have as surplus in the offset account and enjoying our life. And the more aggressive we can go in the front end of this journey and the longer we can hold for, the better the numbers look at the other end. So what you can see is by the time we get to 2036, the market value of the portfolio has grown from being in the 3 millions now to being in the 6 millions. We've now got $3.7 million worth of equity. And over that 10-year period, we've saved up and we've now got 600 grand worth of cash as well, which is essentially about 60 grand a year they've been saving. So our total net position is about $4.3 million. And now what you can see is after that, there's a big dip in the line. And the reason for that is because we go through this period, which we call consolidation, which is essentially when we start to sell down the portfolio and transition our portfolio from being in the growth focus mode into a cash flow focus mode. Because now we want to start enjoying our lifestyle and growth is less important to us. So you can see our portfolio shrinks by about $2.5 million, and that's because we sell down the first residential asset we purchased in 2023. And you can see our cash goes up to $1.99 million. because that's all the proceeds that we get out of the property plus the cash we had sitting in the bank. What we do with that cash is we use it to then go and invest in a commercial asset, of which is this $4.5 million purchase here you can see. And we leverage that at 70%. So we put in 30% cash, plus our stamp duty, etc. And whatever cash is left over, we leave in the offset account. And that takes our portfolio value back up to over $8.5 million. And the way that we're able to get the debt for this property is by taking advantage of a lease doc loan. And remember, in 2038, $4.5 million is not the same as $4.5 million is today. And then we actually sold out another residential asset, which is a second property that we purchased, and do the same thing again. We move that capital into a cash flow producing asset, which is another commercial asset. And that takes our total market value to over $10.5 million. We're still sitting on just under $1 million worth of cash. We're still sitting on $3 million worth of equity, and we've got $7.7 million worth of debt, which for some people would be a worrying amount of debt. But we just let the numbers do the talking. And as you can see, when we go back to our cash flow analysis, this little thing down here is when we started selling down our residential assets and we were negatively cash flowed there. And then you can see as we started to buy the commercial assets, our cash flow dramatically grew. And by 2039, when we buy the second commercial asset, our passive income is sitting at $193,000 per annum. And we've still got 4 years before we need to retire at 51. So between now and when we need to retire, we use all of that passive income just to put in the offset account and decrease our debt essentially. And you can see when we get to 2042, which is 1 year before we want to retire, we hit $333,000 of income, which exceeds our target by over $20,000 for that year. And we're 1 year ahead of where we needed to be when we retired. And when we get to 2043, which is the year we want to retire and we're 51 years old, we've got $385,000 of income. And our target was $320,000, which is essentially $200,000 of today's income, inflation adjusted out at 2.5% per annum. And the best part is, as you can see, this line continues to grow, which essentially means our properties continue to spit off more and more cash. We continue to decrease our debt, and our passive income actually grows during retirement, which is very uncommon. So that is how you can retire on $200,000 a year if you start investing in property in your 30s.